Okay. Hello, everyone, and welcome back to another episode of Vision Money Making Sense. Today, we have some very exciting investment opportunities to discuss with you all. As we always mention, this is a monthly educational financial-based webinar that happens usually on the third Thursday of every month, and it is recorded. If you register, you will get a recording. If you do not register, you generally have to wait about a week or so, but we will upload the recordings to our YouTube channel and our website. Before I hand it over to James Brewer, as a last sort of matter, which I will also say at the end, this is going to be the last visual-based EMMS. We're going to be taking a break in the month of June. And then in July, we're going to be shifting to more of a sort of podcast format. More details of that to come. But this is sort of a transition for us from the normal format you all are used to a little bit of a different format. So with all those housekeeping things out of the way, I'm going to hand things off to James Brewer.
Well, thanks for that intro. And well, if you didn't know, in June, yours truly was nominated and is now a finalist in the investment news category of ESG Advisor of the Year. And that just happened to be on the third Thursday that we would normally be here. So I will be around. Hopefully we'll have some news to share in July about that banquet. So we have one of my favorite returning guests is Corinne Merriman from Ethic, who it's not every day that there is a CFA and a CPA with a smiley face. Often those people don't smile very much, at least the ones that I know. So today we have an interesting agenda because today I'm going to really allow you to learn more about what makes Ethic really different than most solutions that most people have ever heard about, including many financial professionals, because the category known as direct indexing is still relatively new. But today we're going to first kind of give you an idea about, well, what is the index case for values investing? And even talk a little bit about indexes, actually. Then why direct indexing? And then something that comes up when you choose to do or use direct indexing, which is tracking error. Then applying Ethic's 19 sustainability investing pillars to their direct indexing platform. Talk a little bit about return on investment and return on value. So often we just simply hear return on investment and values, but actually there's also risk return when we're talking about things that we're doing investing in the market. And then let you know about their values mapping exercise and a tool that they have that comes out of that values mapping exercise as well. So the index case. Well, first of all, an index is basically, a gathering or a categorization of a lot of stocks, and we can categorize them from international to US. And US, we could talk small, we could talk large, we could talk many different ways. So I'm just giving you an example today of the MSCI All Country World Index, but looking at the one that takes out fossil fuels. So this index has, I don't know, about 2,800, at least I'm going to call it the parent index. That's the All World Index. And then they take out the fossil fuels, and then you can actually see what that return is. And we love it when you can go actually to the methodology. You can't click a link here, but you can look up the index methodology at MSCI. So look from November 2010 through March 2024, a 14-year period. If you follow the blue and, well, the yellow line, a bit faint on the yellow maybe, But you'll see that at the end, the fossil fuels actually outperformed if you look at the line graphs. And then if you look at the annual performance, you can look at every year, and some years one does better than the other, but that's the nature of investing. That's why we really believe in investing for the long run. So it allows the kind of the up and down aspects of the marketplace to smooth out. So there are certain people who believe, well, you shouldn't include anything at all because somehow that'll wreck your return. Well, I don't really believe that's the case. There's lots of different ways to slice and dice investments. And usually, well, we only know in arrears which one actually outperformed. But this one at least shows, and along the 14-year period, you can see how the two kind of a bit mirrored each other. The few times the ex-fossil fuels began to move away from that yellow line, but at the end, it still did have better performance. And that's if you didn't care about fossil fuels. So let me explain how Ethic and Envision work together. So think of a recipe maker. So I like to think of this in terms of recipes. Hopefully you're a foodie and you'll like some of my analogies. So the first thing is, hey, if I'm gonna make something like, I don't know, I made some shrimp recently with a fajita blend. And well, what is the recipe that I want to use? So I looked through a few recipes, came upon one that sounded like I liked it. And then I had to go and see what the various percentages, they're using a tablespoon, maybe a half a teaspoon, whatever, different ingredients in different percentages. Well, that's just telling me what I should have. Now, if I go to, in Chicago, Mariano's, Jewel, or a couple of the places you can get your groceries, which one off the shelf do I want to pick? I mean, there's different brands of different spices that I could pick, and some cost more than others, comes less, or you could try to buy it yourself and do some grinding if you so choose. Well, think of this in a way of how we're doing investing, and in this case, in the pick ingredients, that's where Corinne and the folks at Ethic come in to play. So how and what should we be filling the recipe? Well, there's a minimum dollar amount that Corinne's team has. So we actually have a version of what we call the Envision Justice series. And that uses mutual funds, and we screen for 3 particular things in that version, which is racial equity, women's empowerment, and planet, or we could probably call it environmental. And then there's the version that is powered by Ethic. But with Ethic, they even have an extra variation on top of the standard one that we use. And that is my setup for Corinne to start telling you about the why you would want to use Ethic. So I'm going to stop my share and have Corinne share her screen.
Amazing. Thank you so much, James, and great to be with you all. Thank you for the opportunity to share a little bit more about Ethic. I'm going to pull up my screen here, and we will get back into a little bit between that division of the Envision Wealth series on a lower account size and Envision Wealth Justice series as managed by Ethic here in a few slides, but I wanted to just share kind of high level what it is we seek to do here, and then we'll get into a little bit more of those details. So I think what's really powerful in working with a firm like Envision Wealth and an individual like James, who is so passionate about specific issues, is that we could really partner together to create this great investor experience for you all. And kind of 3 key stages in that investor experience are first defining that mission statement. So as James mentioned in the Envision Justice series, the mission statement includes climate, racial justice, and women's rights. But we also have the opportunity to make custom mission statements to you as individuals as well. But that we created that mission statement with James because we'd heard that from so many clients, and those were values that he wanted to really put forward out in the world for being aligned with Envision Wealth Planning's values. And as part of that, once we have a mission statement, that gives us the framework in order to be able to evaluate if you are or are not invested in line with your values today, which is super easy on our end to then essentially just run a diagnostic with any individual stock or fund holdings that you have and are invested in today. We work with James to help evaluate those existing holdings and really bring to life some information on maybe you didn't know that you were exposed to a certain area. And we'll talk a little bit more about that as well. And then we build a personalized portfolio. And so we're going to talk a little bit about what that personalization really means. So moving forward here, there's a reason that we have these higher minimums associated with strategies managed by Ethic, and that's because we're creating this individual stock portfolio composed of a diversified pool of individual stocks. And so the reasons higher minimums go with that is that we need a certain dollar value in order to be able to purchase a pool of individual stocks. The stocks in the US have grown to be very expensive over the last couple of years, so we need a minimum amount to be able to diversify your portfolio. There's this word in the industry that we use too. It's a category that Ethic falls into called direct indexed, but it's specifically referring to us holding the individual stocks of that underlying index rather than a fund tracking it. The personalization comes into play here across three main categories. As you can maybe tell by our name, values is really important to us. So there's that values alignment piece, which we'll talk some about today. But then there's also personalization on the financial details and also the tax considerations if we're managing a taxable account on behalf of on your behalf. So the financial piece is what market exposure makes sense. And James is really involved in the definition of what overall exposure makes sense for your public equity or your stock portion of your portfolio, as well as any tax considerations. So if you're invested today and moving to a new portfolio, we want to make sure initially that you're not exposed to any unwanted or unexpected realized gains as part of that transition. And then on an ongoing basis, if it makes sense for your financial situation, we can harvest losses on behalf of your account. But today we're going to really focus on these benefits of values alignment and direct indexing. So specifically, I'll start with that piece of the personalization relative to mutual funds and ETFs. So mutual funds and ETFs, many of us are familiar with. It is those single line items that we potentially see on our statements, which hold a wide variety of investments underneath, but you just see the name on your individual statement. What that allows for is the manager to manage everything inside that individual fund, and they can be actively managed, that a manager is actually making decisions to buy and sell out of the underlying holdings, or they can be passive and tracking an overall index, be that in the US or global or international. And it really does allow for access to diversified exposure, no matter your account size. You can have many mutual funds, you can have $1,000 to invest and have access to a really diversified exposure. So there's a great benefit there. However, as clients overall nest egg, as some call it in the industry, or investment portfolio grow, there are other benefits of diversifying beyond the individual fund exposure. And so the considerations associated with mutual funds and ETFs and why you may choose to go a more personalized route, although there's many benefits here, is that lack of customization, the ability to have slightly more access to personalization or access to investment team members, and also the ability to vote proxies on behalf of the account. So as an individual stockholder, you are actually seeing those company names and have the option to be advocates for the issues that you care about going on the proxy ballot at the individual companies. And so there have been a couple of big headline proxy votes over the last couple of years. So you have the opportunity to individually participate in that if you're holding the stocks and not if you're holding the overall fund. So that's what that means here as part of those considerations. Alternatively, the additional jargon in the industry includes separately managed accounts. So that means that there is a single account in which we're managing a wide variety of stocks within. I can also include funds, but in our case, it's individual stocks. And those are directly owned by you as the investor, with Ethic at managing them on your behalf. As we've talked about so far, there are several benefits here in regards to personalization. I think what's really interesting about holding a portfolio of 200 to 300 stocks is no matter the market, there's typically some stocks that are outperforming and some stocks that are underperforming. So we are able to have some tax efficiency and harvest some losses there, if that makes sense to you. I already discussed a little bit about proxy voting. There's also some cost benefits as well. Some, the fees on our accounts are very competitive with low cost offerings. And there is this direct access piece where actually James, has conversations with you, and then through our advisor portal can provide additional details directly back to Ethics investment team to further curate the strategy to make sure it's to your liking from a financial consideration, values, and tax perspective. I think the number one thing here from a considerations piece is it absolutely takes a little bit of education, because it can be overwhelming to all of a sudden go from seeing just a single name of a fund on your holdings or on your quarterly or semi-annual statement to actually seeing 200 to 300 names and seeing all of those companies you're invested in, or seeing more trades than you'd expected to see in the past. And so that's the great role that James plays and Ethics supports. If there are additional questions, is kind of why you're holding certain names, why you're trading out of certain names. And that's one of the many benefits of relying on a financial advisor to be there for part of that education.
So if I could just jump in a little here. So a lot of people who come to us are familiar with names like Vanguard or Fidelity, maybe TIAA, CREF. So in some of the references that Corinne had, so Vanguard is essentially a passive strategy. They look to companies who develop these indexes that I talked a little bit about earlier, and then they just find a way for people to invest in those indexes. But they don't necessarily tell you which indexes to choose unless you decide to choose one of their asset allocation funds, which I haven't had anyone show up who has done that. But you may have had that at your workplace. Then there's Fidelity, when she was talking about active management. So Fidelity has been known for its active management, where somebody is thinking about, like, well, what should I be? Whatever the portfolio manager's prospectus tells them that they can do, then they're looking and coming up with the different ways they want to slice and dice. Potentially they're actually using values, but maybe not. But let's call it more like KFC and that secret recipe that they never tell you about. And all you get to see is what it tastes like, but nobody ever tells you much about the recipe. And then when she referenced, their strategy regarding direct indexing and cost, you will find that the cost on a continuum is closer to the benefits of the passive side than it is closer to most of the active managers, and I'd say most, and some are really a lot more expensive, while at the same time giving you the ability to customize. So that's kind of sounds pretty cool to me, that you get to customize and get closer to the lower cost pricing on the other side. Because, well, most of the time I like when somebody else does the cooking. I don't want to do the cooking. So that's just some thoughts that I had to further embellish some points in case people were like, I don't know what this active and passive thing means.
Completely fair. Thank you for elaborating, James. Awesome. So, these are some of the benefits of that customization, just laid out a little bit differently. So to recap, within a direct indexed portfolio, you have the opportunity to personalize the portfolio to the financial exposure, to the values, which we'll talk a little bit about next. And then also be a part of that experience. So going through and defining those values, diagnosing your current portfolio and potentially seeing the impact that your portfolio is having. And then on an ongoing basis, once you're invested in that portfolio, you can be aware of and select the policy with which you're voting proxies, or do so yourself if you're curious. And then we have really holistic reporting that if we're voting proxies on your behalf in a socially responsible way, we're reporting back to you on how we voted proxies, what tax benefits you've gotten, and what kind of impact your portfolio is seeing, like how many emissions you have, or how much you've decreased your overall emissions footprint relative to the index, maybe how much you have more diversified your workforces. So have really holistic reporting to continue to check in on those values that you've elected on an ongoing basis. So I mentioned several times now that you have the ability to elect your own values. At Ethic, we have done deep and robust research on 19 different issues that we feel are some of the most important issues facing the world today, and are also issue areas where public companies can have impact. And so you see those 19 different issues listed here. And within them, you'll see some themes in terms of environmental issues, social justice issues, and corporate ethics issues. But there's also a lot of interconnectivity in these areas. There's a lot to do with health and wellness that's actually related also to environmental considerations. As you can imagine, something like pollution is also involved in health and wellness. So there's interconnectivity here, but as part of the experience that James has gone through on behalf of clients, and you can also go through yourself, you can elect anywhere from 1 to 5 of these issues as being the most important issues to you. And that's where we address the impact and evaluate companies based off the issues that matter. If you can imagine a pyramid, these are really the top of that pyramid, or if we're going with the recipe analogy, this is the name of the recipe, and there is a lot going into the ingredients underneath. And that's where our incredible team comes in with both data experts and also research experts that define what does it mean to have impact on something like clean water or racial justice, and how we evaluate that. And that comes to life a little bit here. But once we've selected those issues that are most important to you, that's defining that sustainability focus. And then the way that comes together, we partner with James to determine what benchmark or financial exposure makes sense. And then we really see it as a binary decision. Either a company is aligned with that sustainability focus with your values, or they're not. And so that's why you see this pass-fail indication here. Either a company is or is not aligned with your values. If they get the green light, then that company is considered as a part of your potential investment universe. And that's how we then create you a diversified portfolio that's both seeking to keep up with the overall market, as if you're invested in a Vanguard passive fund today, as well as is just composed of companies that are aligned with your specific values. I think what's important to note from the Envision perspective, as we've talked about this a little bit so far, and this was James's final slide that I get to tie back into here, is there's really two routes in terms of working with Envision to create a direct index portfolio managed by Ethic. There's the core value strategy, which we've spent a lot of time with James on in terms of what makes the most sense for his clients. And then there's also the custom route. So within the core values, we've worked to create two different really personalized strategies that clients have been interested in both options. One is that we call core values, is a little bit more tightly tracking the overall index. So if you think about a three-legged stool of my priorities are keeping up with market performance, having an intentional impact, and also tax management. The first is going to slightly more prioritize that market performance. So making sure we're tracking the market. And then the second one, which we call the high conviction one, is for those clients that are a little bit more impact focused and are saying, I'm okay with a little bit of deviation, both up or down from the overall market index, but I want to be more intentional in terms of my company selection. And a lot of times when working with Envision clients, we show both and just allow clients to dig in and have a better understanding of what each means before moving forward there. And in terms of the custom route, this is a slightly higher minimum for the account because of the additional time invested by you as the investor and James and the Ethic team. But there's so many benefits that come along with that customization too. If you have other values from that prior slide in terms of the 19 pillars that really speak to you, maybe you're really passionate about animal welfare, for example, just one of the other 19 that's not included in the Envision Wealth series, you can absolutely come in and create your own mission statement for your portfolio. And we're going to have really intentional impact on those issues that matter most to you. Some of the other benefits there is that definition of creating additional financial exposure. If there's another factor, for example, that may make sense, if you want to have you and James agree that it makes more sense to have maybe a more growth or value focused portfolio. And you can also do individual security selection. So maybe there are a couple names that you want to make sure you don't have exposure to. That's all an option within that customization piece. It involves a little bit more time on your end. There's an incredible values questionnaire that you can go through to define that solution. And so it is making sure that you want to be involved in that, but it ultimately creates something even more personalized to you as the individual investor or your family. So jumping back to the Envision Wealth series, both in the core values and the core values high conviction series, the three values that we've come together as really aligned with Envision's mission is climate change, racial justice, and women's rights. And you can see those three highlighted here. And there's definitely interconnectivity there. There's our research team agrees there's a lot of that has having positive impact on an issue like racial justice can have be a rising tide lifts all boats for women's rights and the climate as well. So there's a lot of interconnectivity, but there's also a lot of specificity in terms of having impact on each of these individual issues. I think
Corinne, could you give us a potential example that really shows the discernment between the standard conviction and the high conviction?
Yeah, absolutely. So I think from one of the things when it comes to climate, for example, we can use that as an example. When we're talking about kind of that core values being a little bit less strict in our evaluation of company behaviors, there's still a lot of intentionality there. And so when we're talking about carbon emissions from individual companies, we're going to be eliminating companies that are really directly involved in the fossil fuel industry. So companies that are like an Exxon or a Chevron in the world, that they are directly involved in the fossil fuel industry. What in the sustainability space, having direct emissions is known as scope 1 emissions, or it comes from your business operations, whereas scope 2 is more related to overall company operations and transportation. And so as we get more strict, as we move into that high conviction, we're going to even be looking at companies that have greater impact, even if they're not directly involved in the fossil fuel industry. So that may be in relation to companies that just have enormous carbon footprints from their electricity bills or their transportation bills. So going to be companies often outside of the fossil fuel sector, but that are just enormous and haven't done much to offset their overall footprint from their operations. So you get to really dig in. I think what's powerful is for clients to have the two up next to each other when they're trying to understand the difference, and looking at those company names that would or would not end up in the portfolio, and being able to say, yes, that feels aligned for me for this large tech company to be included or excluded because of XYZ, and allowing to really bring that to life at just a couple of individual companies that you see in the news a lot or something like that, for clients to be able to really make a decision around.
And so far, thanks for clarifying that. I learned something all the time. I didn't know about scope 2, so thank you. But one of the things that I've seen when you have sent me back samples to show my clients, that often let's say, creating a hypothetical example, let's say that the index we're tracking, I'm just going to throw one out. So on 2 slides ago, you mentioned the S&P 500. That's not the actual one that Envision uses. I'm going to use another one just for this. Say you want the top 1,000 companies, for example. So let's say that we were looking at the top 1,000 companies, and Corinne gave me back, here's standard and here's high conviction. It has been my observation that when we go to the standard conviction, that's similar to the slide that I showed you, that fossil fuels was actually outperforming the MSCI parent version, that's been what I've seen. And then in the high conviction, I've seen that the number has been lower than that other number. So let's say it was 10 and the new number is, say it's 9.75%.
Mm-hmm.
So I think Corinne's thought of, well, you could look at both of them and you could say, well, potentially you could have 10.25. Again, this is hypothetical, or 9.75. But if you really are convicted that you don't want to see, in this case, that scope 2, and that 9.75 is fine to you.
Mm-hmm.
And that, at least on the planning side, that just could mean that you may have to save a little bit more if that was somehow going to impact a future objective. But trying to give you like a better idea that we're trying to go against whatever the selected benchmark is, and that's part of what Envision comes up with. But in you choosing your conviction, that again might mean a little bit less, but you may see that you got the same outcome as the first example we did with the MSCI equity that was without fossil fuels.
Absolutely. And sustainable investing is truly still so new. It's around having great data in this space has really only been around since 2015 or so. And so the more time we have, the more data we'll have in terms of being able to look back and see how different strategies perform. But next year will be the first time we're really able even to look at like a 10-year number on how sustainable strategies have performed. And it's been a crazy 10 years. There's been a lot going on in the markets, in the energy markets, in the global economy to have, it's really interesting to look at different years and what what has done well and what hasn't. So yeah, there's definitely a lot of data there that can be reviewed. One of the benefits we'll talk about here in a few minutes of a direct index portfolio is really being able to provide you as your clients the deviation we expect from the market to be able to make a really informed decision about that. Awesome. So in terms of that approach to the sustainability, I gave a climate example on the prior slide. This is in terms of the difference between our core and our high conviction strategies that we've created together. This is an example of ethic kind of more versus the industry in terms of the data that's getting included and just how rigorous our approach is to every single one of the issues we talk about or that we have the option to invest in our portfolios. So what you can see here is many of the options in the industry to express racial justice as an issue that is important to an individual investor often takes into account the publicly available information for companies. And so publicly available information can include information like the board of directors and the diversity there. You can go to any public company's website and take a look at who their board of directors is. And so that's often taken into consideration. Also, there are certain policies and practices that public companies have in place, including labor relations and anti-discrimination policies that are also going to be publicly available and can be considered as a part of the quality of that policy and whether and so included as part of an investment selection decision. What you can see here on the right-hand side of the screen is just how much bigger our approach is in terms of data points considered. And that's because we want to be as intentional as possible of really addressing impact on these issues and also in defining the communities that we're addressing impact in really distinct categories. So we're looking at company behaviors first and foremost in the workplace. That is often what comes to mind for investors, especially when it comes to social justice issues, is some of those indicators like are considered in the industry approach, like board diversity and policies and practices that companies have in place. But we're also looking at like human capital development practices as well. What kind of resources are available to minority communities as well? And also worker safety standards. A lot of worker safety and working conditions disproportionately impact minority communities. So that's a consideration there. So that first bucket is going to be the employees of every public company. When James mentioned that we're considering kind of a universe of 1,000 companies, we're going to start there with employees. We're also considering company behaviors within their operations and supply chain and their impacts on their communities. So assessing whether or not companies have had any community relations violations or certain products that actually impact communities. So things like weapons or creating cash bail bonds, things like that, products of companies that disproportionately impact minority communities, firearms productions, for example. We don't want to invest you in anything that has weapons or predatory lending practices. And then finally, we're also looking at labor considerations in regards to private prisons and prison operations and use of prison labor. That's one of the most direct ways public companies are still involved in the prison industrial complex. So that's a consideration here as well. So you can see here, there's lots of examples, and I love to dig into these examples with investors and empower James with stories here. So if there are questions around the approach, we can always share more about all the data, but wanted to just kind of share a few examples of everything that's going on under the surface. So when you select a specific issue that matters to you, you can have a lot of confidence in the amount of research that informs that specific issue. We also provide a ton of transparency in our fact sheets and on our advisor and client platform to be able to see specific companies that are involved in these practices that we don't want to invest you in, and all of the sustainability reasons why. So you can see a couple companies highlighted here and their policies, their diversity policies and practices that don't live up to our standards, and so are going to get removed from that that Envision Wealth Justice Series core values strategy. So you can see a few names here. And what this is just sharing is this makes up about 5% of that 1,000 company universe. And so we would be excluding about 5% based off this specific data point of diversity policies and practices. We also want to show you the positive impact that you're having. One of the areas where, both in regards to women's rights and racial justice, that we have great data around today is gender diversity at all levels of employment. So we're going to play back to you the difference your portfolio is having versus that 1,000 company universe. And you can see a few of those examples here. And you may be saying, Corinne, that 38 versus 40% is not a huge difference in terms of overall diversity in the workforce. But I think it is really powerful to know when you look at women on the board, for example, every public company today does have a single woman on the board in the S&P 500. And so the top 500 companies do have a single female on the board. But then to get beyond that, there's almost no boards that have more than a 50-50 gender breakdown between women and men, I should say. And so it is actually quite hard to divest and make huge differences in terms of that diversity. So actually having an average of your overall portfolio going up by a couple percentage points is actually supporting a significant portion of women at employees, managers, and board of directors levels. So really, we want to continue to improve upon these metrics. And that's one of the benefits of us being a manager on an ongoing basis, is we can continue to seek to improve. But those are the smaller differences that you're seeing there, but really important to us to have positive impact and continue to have positive impact here. I mentioned the private prison and border detention facilities as a really important data point to us when it comes to having impact on racial justice. So I wanted to just highlight this as another area that's included, and you may be surprised by the companies that are still involved in this space or use this type of labor. And so really, powerful to have this information about your portfolio as you get into this personalization. And this is, an important data point for us that comes from one of our many data providers that we really think this is a great way that we can have impact on racial justice in the public company space. And then finally, I mentioned earlier, environmental considerations are a huge part of both racial justice and women's rights considerations. And so we're also going to measure for you and play back to you the difference in the your portfolio is having across a wide variety of environmental metrics, including some things like carbon emissions and hazardous waste. So you can see here the mega difference your portfolio can have versus the overall index. And we love to share with you a couple of equivalencies to just understand a little bit better what the heck it means to have difference in kilograms of hazardous waste, and really playing back to you how many, for example, trash bags that is, or when it comes to carbon emissions, playing back to you how many gallons of gas that could equate to on an annualized basis and the difference your portfolio could make. Awesome. So James and I mentioned a little bit previously that deviation from the overall market and quoted a few different returns of that core value strategy and the high conviction strategy as just examples of hypothetically what that could look like. I think what's really important to know is in a direct indexed portfolio, you will always be getting information about the expected tracking error, a buzzy term in a statistical term that we look to. But what's important about it is that when we're proposing a new portfolio to you, we want to give you an idea of how much your portfolio will deviate from the market. So if the market had a 10% return this year, a sample portfolio with a 1% tracking means that it would be 1% deviation. It would expect to be 1% deviation from that overall market return. So if the market is returning 10%, that means that plus or minus one of that, you can expect your portfolio to be in that range, which is what this small funnel looks like here. So in a 10% return, you could expect anywhere from 9 to 11% from your portfolio in a normal market year. If we look at portfolios that have upwards of 5% tracking, you can see that that has substantially larger deviation. So in the case of a 10% market return, that means that we expect the portfolio to be anywhere from a 5% to a 15% tracking. So it's really in regards to your personal risk budget, and James will evaluate with you kind of your overall risk tolerance, and that plays into consideration here as well in terms of how much tracking difference are you willing to take. So that's just more information that you'll receive as part of the proposal to help you set personal expectations of what that portfolio could look like, and the trade-offs between being out of more companies that are overall in the market index that may not be aligned with your values, and what you could expect in terms of performance there. So I think it's just helpful to share that with you. It's really just an important part of that proposal that we can review better together in terms of moving forward. Awesome. James, anything else you want to share there?
Well, I've never seen you give me anything that said 5% tracking error.
That's
So
correct.
this
is purely for
yes,
illustrative purposes.
Yes, just letting people know that, don't think that we're going to give you something all over the place. We are investing. I should have said that CFA, which more people have heard of CPA, especially around tax time, is that she is a chartered financial analyst, which is considered by most to be the superior investing credential in the industry. So I just like for you to know who she is. I'm a certified financial planner. I haven't done as deep a dive into investing as Corinne, but my dive's pretty deep, but not quite as deep as Corinne's. So, but we're here, trying to help you again find the, right balance between your risk return and your return on values.
Awesome. Thanks, James. I see we do have a question in the Q&A section, but if you want to take a look at that, but I'll wrap us up here in terms of, we've talked about a lot today. You have had a thorough education on the world of direct indexing, and what I want you to walk away with is there's lots of different options in terms of working with James and Envision Wealth. And there's a variety of reasons as to why you could choose any of the buckets, any of the recipes. There's a smaller account option available that's great to still get that diversification, that values alignment. But if you have the minimums and are interested in a values aligned portfolio, there are other great options powered by Ethic to help continue to incorporate your values into your investments and get that additional personalization if you're curious to be even more involved in kind of that mission creation for your portfolio. But what you're looking at here is kind of that potential next step of if you're just curious about what you're invested in today and how aligned or not aligned it is with your values. So there's an opportunity as a next step to share with James your current holdings and be able to evaluate that based off of either the Envision Justice series mission statement, or if you would like to go through the process of creating your own mission statement and then evaluating your current investment. So it's very little time investment, but it's just giving you more transparency and information and education on where your investments are today, being able to look through the hood of funds and see what's underlying the surface. And a huge thing, as is clear by perhaps the last 50 minutes or so, a huge thing that's important to Ethic is that education and transparency. So James and I just wanted to offer that as a next step. James, I'll turn it back over to you.
All right, great. Why don't you just leave your screen up and we can just tell people how to reach Envision later. But I thought I would discuss the first question, which had to do with the sustainability pillars themselves. One thing that was interesting that I found is in our, let's call it our own health check. So when we get back information, we can see the extent that any pillar in particular had on the investment blend that we have Ethic use for us. And it has been interesting to me to see that the ratio has had the greatest number of excluding companies compared to the other two. I just found that to be very interesting. But what I will say is that as you start potentially to add from your, say, 1 to 5, that eventually there's going to be less impact, maybe no impact, until there's a point where the impact is there's no company standing. So it's trying to find this balance. So no company standing. So behind the scenes, and we only had so much time today. So let's say inside of a given index that we're trying to create, let's go back to that top 1,000 companies. Inside the top 1,000 companies, you're going to see they're in different sectors. Let's say some are in energy, some are in healthcare, some are in finance. Well, when Corinne's team goes back and does their thing, and they take out companies, they're actually looking at the universe left and trying to reconstruct as best they can what the various sectors of that given index had. So if it was 10% finance, they want to, of the remaining companies that we've screened out of finance, they want to recreate the new index having 10%. And if the one was 20% energy and there's like one company, then they'd have to make that one company be all the 20%. So the idea is that they have enough to create something that from an investing perspective does have some, I'm trying to find a good word, some basis for feeling that they have diversification and some expectation that they're going to get close to what that sector inside of that index is going to give. So as you start to exclude more, it becomes increasingly difficult, and you could potentially knock out sectors. So I have to be a fiduciary to my clients directly, as you are my client. So there's a point that we would go beyond what I could stand behind. And potentially that proxy voting, which is trying to change behavior at companies, could be one of the ways that we try to go and impact, either the companies that remain that aren't exactly the best that you'd like, to try to get them more in alignment. What do you think about that answer, Corinne?
You're absolutely right. It was a great explanation. Yeah, I'm sorry, I kind of skipped over the how we then reconstruct the portfolio earlier. But
there's so much to be said. This is why I decided that this ethics solution deserved a day, and it's still, we're seeing that there's questions that even go beyond. Mm-hmm. So I'll let you talk to the question of, I heard the direct indexing offers tax loss harvesting. Could you talk about that?
Absolutely. Yeah. So yes, you're right. The world of direct indexing has actually been around for far longer than robust sustainability data has been. And it was originally created around the benefits of tax loss harvesting. And one of the reasons that this is now a possibility is because thanks to a competition between a couple of different custodians, there was a race to zero over trade commissions. And so now we can trade individual stocks commission free. That was true about 15 years ago or so. And so because of that, we're able to trade in and out of individual stocks without having to worry about the trade cost piece. And so just being able to give you tax benefits. And so at Ethic, the way that works is you're holding a portfolio of 200 to 300 individual stocks. Our team is actually monitoring your portfolio, thanks to the way our technology is set up, on a daily basis. And if your portfolio ends up having meaningful losses, which we define as a certain percentage of the overall value of your account, our team runs possible scenarios of how we could maximize harvesting those losses on your behalf and still having a great diversified portfolio. And then we'll harvest those losses and continue to monitor the account. The way that we do it is really intentional. And so you don't have to wait for wash sale periods to be up or anything like that. We are able to harvest losses intra-month. So really the benefits are that I think a great way to think about it is if you are in a single ETF versus a diversified direct indexing portfolio, in a single ETF, if we're in an upwards market, there's going to be no losses to harvest because the whole account, the whole fund has gone up. If we're in a flat market where the portfolio hasn't benefited at all from market returns but hasn't lost anything, there's no benefits to tax loss harvesting. But if you're in a down market, you can sell out of that ETF and harvest losses and invest in something else. In a single stock portfolio that has 200 to 300 names, whether you're in an up market, a sideways market, or a down market, within the composition of those 200 to 300 names, there are going to be companies that are outperforming and companies that are underperforming the overall market. And so we have the possibility, no matter what's going on in the broader market, to be able to often harvest losses on behalf of your account and give you that added tax benefit in addition to all the other benefits that you're getting from being invested, from tightly tracking the market and being values aligned. Ethic manages about $5 billion in assets today. And across our taxable accounts, about 2/3 of those take advantage of our tax loss harvesting capabilities because clients have seen so much of the benefits of that.
I love that. And I'm going to try to make a couple of closing comments. So first, I often explain that Corinne may not know this, that in the Envision Justice series, we have the mutual fund version because sometimes people just don't or aren't at the value or the dollar account size that is required for Ethic. But we do our best to find, and we talk to the investment man or the portfolio managers to understand them, and we have research to try to get as close to we can of matching those three pillars in our portfolios. What I refer to as Ethic as being the purest form of the Envision Justice series. It's the purest form because of the customizations that we're actually talking about today. And it can even be more pure for you, if your investment dollar value is $500,000 or above. Recent political conditions have some people on different sides of different things. And it might be 2 or 3 companies that you discover, like that one sheet earlier that said, "Oh, I didn't know that XYZ company was involved in blah. I want to get them out." Well, that's not going to happen in the mutual fund or exchange traded fund version, but you can come to me and I'll tell Corinne, "Hey, my client wants to get out of this particular stock." Now, I also like to say that a divesting, get me out of the stock, is also an investing, because potentially that means that they're going to invest, take the cash after you've sold out, and then rebalance to get back to that sector size. So know that you're just not always pulling out, which a bit is like the question of, if I went and just give me all 19. Well, eventually we may not have zero. But so we still want to stay invested, but it gives you the ability to make some tweaks and tunes that really, get closer to who you are and what your values are. So I want to thank Corinne so much for always being there when Envision calls. And my clients thank them for making my clients happy. So thank you for that part. I'm James Brewer. If this is a first time for you, I can be reached at jb@envisionwealth.us, jb@envisionwealth.us. Please just simply email there and let us know how we can get you better aligned to your values or whatever other questions you may have. So thank you all for your time today.
Thank you, James.
Thank you, James. Thank you, Corinne. And as mentioned, we will not be having this webinar series next month, but please be on the lookout for your emails and social posts, as we will have some announcements about what July will look like for all of us. All right, have a good one.